Shea Rubenstein here, Executive Vice President of the JCon conferences, and we are going to discuss all things real estate, from interest rates to purchasing, refinance, construction, and development.
Hi, this is Henry Stimler, Executive Managing Director of NEWMARK, where we will be delving into all things real estate. Tremendous show with great insight and great intel.
Hi, I'm Shimon, Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank. And we'll be talking about our bank's lending today. We certainly are.
Hi, Joseph Kahn from VisionRE Real Estate Advisors, here all about where we think the market is in 2023 and how this today might be the greatest opportunity to get involved in real estate in a long time.
Tonight's show is all about the real estate outlook in 2023. I'm going to be joined by some incredible guests, and I'm co-hosted once again by my good friend Shea Rubenstein. Shea, thank you for joining me here on Mind Your Business.
What a pleasure, Yitzchok, to be back. And
thank you.
A great topic to cover tonight, so I think it'll be exciting for our listeners.
Absolutely. Before we get to Shea and the guests, first of all, a special thank you to the great listenership of this program. We are once again number 3 in the Nielsen ratings. Top 10, New York AM radio. That's a big deal. That's because of the great guests and the people, all the listeners out there who have come to expect incredible, important business content week in and week out. Tonight's show, upcoming very, very soon. It's going to happen before we know it. Tuesday, July 11th, 2023. The Hilton in Staten Island, the JCon Real Estate Summit. It's the 6th annual JCon Real Estate Summit. She is the brainchild of it. And we're going to be speaking with some incredible guests tonight. Henry Stimler, Executive Managing Director at NEWMARK. Joseph Kahn, founder of VisionRE. Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank. On tonight's show, we will discuss, now of course, it's a teaser of what is going to be at the JCon Real Estate Summit, Tuesday, July 11th, 2023 at the Hilton in Staten Island in the afternoon. Of course, for more information, attendjcon.com, attendjcon.com. On tonight's show, we're going to be talking about choosing the right property, spotting the right property, analysis and assessment strategies for commercial real estate, and securing a construction real estate loan, and what are the going rates. Without further ado, welcome to this great team here to a special edition of Mind Your Business. And thank you, Shea.
Wow, what a great introduction.
Thank you. So the real estate outlook of 2023, perhaps, Shea, in 2 to 3, it's not fair to only give you 2 to 3 minutes on this, but in 2 to 3 minutes, give us a little information what to expect at the JCon Real Estate Conference.
Thank you, Yitzchok, once again, and thank you to my fellow people on this radio show. So it's definitely exciting to be here once again. And yeah, so the upcoming real estate conference that, like you mentioned, it's the 6th annual. It's pretty much, bringing the professionals in the industry, people who are in the real estate space. Everyone is, somewhat different. Some people are into leasing, sales, construction, finance. But as long as people are within the space, we'd love you to be here.
And if I'm not mistaken, in the past, you drew over 600 or close to 600 people?
Yeah, our average event has about 700 people, and we hope to have an even better crowd. So the idea really is to bring people up to date, as we'll hear from the professionals today, where leasing stands or finance or loans or, assessing properties. So that's definitely some of the topics that will be covered at the event. And definitely want to turn it back over to you to ask our questions.
Henry Stimler, coming to us for tonight's show live from Florida. Henry, how are you today?
Doing great. How are you guys?
Amazing. So, how does someone know, perhaps you can give your take, how does someone know how to buy a property, some background in terms of really spotting a great deal now, mid-2023?
So first of all, you got to choose your spots, right? So we've had 7 years of good. Everything's been hunky-dory. You bought a property 2 years ago. Cap rates kept on declining. You're making money. It was very, very simple. We're in a whole different ball game right now. Now it's no longer just buying anything and value is going to keep on going up. Those days are over. So now you really have to pick the right spots to buy in, and you have to have the right strategy to buy in. 2 years ago, I would say what everyone was buying was value-add multifamily. That was vogue. You bought a 70s product. you put some money, you fix the units, you re-tenanted the units, you went back to the bank with your new rent roll, and you had a cash out refi. Those days are over. First of all, it's very hard to buy value add today because you don't have floating rate loans today are so expensive. Typically, the floating rate loans are over SOFR. SOFR's at close to 5%. So that whole business is kind of shut up shop. So what are you meant to buy? If you've been a value add buyer in the past, you fix the units today, it's very hard to cash out refi where rates are. You have to change your strategy. So what we're seeing a lot of stress on the merchant builders, guys that built properties. Merchant construction loans are all floating rate loans. Those loans, when they started 2 years ago, SOFR was at 10. Now SOFR's at 5. They were paying 300-400 over SOFR. So their cost of their monthly borrowing costs have gone through the roof. So there's tremendous pressure on the merchant builders. They need to sell. They need to move on. They're paying 8-9%. They're getting destroyed. So that's where I think the opportunity is today, is to buy new built multi, find the developers that are struggling and take advantage of that and buy very well based on price per pound. Because, I'll give you an example. Austin was trading at a 3 cap market today. So a typical unit on Austin was 350 plus. That same property today in Austin is trading for 250, 260, 270. So there's a huge price delta. Take advantage of those opportunities.
We're speaking with Henry Stimler, executive managing director at NEWMARK. Shea, I hand it over to you.
Okay, that's very interesting. So I guess if you have to define which markets do you think are doing better than others, whether it be geographical territory or, like you mentioned before, a different asset class?
So I'm going to stick to multi. I don't really want to talk about what's going on in office. It's not my core competency. And we all know what's going on in office. So I'm not going to add any new chedushim there. Let's stick to multi. So I think the best places to buy today is slow and steady wins the race. You had markets that went through the roof. Tampa went from 3% market growth to 19% market growth. That is not sustainable. So you want to go to markets that just slowly tick up, nice rental growth, solid markets, not places where you've got a ton of units coming online. I love the Midwest. I think the Midwest is always slow and steady wins the race. I love Columbus because, again, Columbus, Lexington, St. Louis, Indianapolis, these markets are seeing great rental growth, but they never had the cap rate compression that the Sunbelt states did. Texas, Carolinas, Atlanta, Austin, Texas, for example, it never got that hot in those markets. So you can go into those markets, buy decent cap rates, and you're not exposed to the risks you have in markets that got overheated and all the developers went running to bring on thousands of new units. I want to read you something very interesting that came out on RealPage Analytics 2 days ago. U.S. apartment rent growth leaders. So obviously Miami, where I am, we all know what's going on. Miami, that's got 8.1% rent growth. And then afterwards, you're going to be very surprised what are the next numbers. Number 2 is Northern New Jersey, very closely behind Miami at 7.9% rental growth. Then Cincinnati, Ohio, Indianapolis, Columbus, Kansas City, and St. Louis. So you see that the hot markets of last year are last year's hot markets. The good, solid markets today is predominantly made up of the Midwest markets.
Very interesting. Thank you for that.
What about value add? Just to get back, I know Henry mentioned this before. Question is, can you buy value add deals in this market just to hold on to that?
Okay, so the only really way to buy value add deals today, remember, what was the whole shtick of value add? Last year, the year before, everybody was going to debt funds, borrowing 80% purchase, 100% of CapEx future funded. So you were going in, you were going to put $15,000 into 50% of the units. The debt funds were lending you that money. And then you would do the work, and then you would take out your debt fund loan with an agency loan when you pushed NOI. Today, to borrow from the debt funds, you're paying 400-500 over SOFR. So you're paying 9%. That doesn't make sense anymore. The agencies don't lend future funding. So you have to come out of your own pocket, the money you're going to put into the property. And to get that money out, it's going to be very difficult. So the only place value add really works is if you're already buying a high cap rate deal. If you're buying a 5.5, 5.9, 5.8 to 6 cap deal, that's where value add can work. But anything skinnier than that, you can't buy a 4 cap deal and say, oh, it's going to grow to a 6 cap. It's too much of a delta. It's too far apart. The only deals for value add that make sense today are, again, high cap rate markets.
Very well said. Thank you for that. And before we continue, if we can just remind people.
Yes, this show is a preview of the upcoming JCon Real Estate Summit, which is going to be held on Tuesday, July 11th at the Hilton in Staten Island. It's in the afternoon. It's basically 6 to 10?
It's about from 4:30 until 10.
Oh, I'm sorry. 4:30 until 10. I mean, people come early. There's a lot of food, by the way. Not that you're going for the food. You're going to get your brain wired for the real estate market of 2023. But there's a lot of good food as well, right? It doesn't hurt, Shea, right?
There definitely is. There's a lot to do there. But, people come originally, for all the seminars and panels and keynotes. And then we have, the dinner and networking.
And Shea, we have some fantastic, besides the guys on this show, we've also got some fantastic other guests that have great insight, great market intel. They're in the market from owners, buyers, brokers. So we've got a really good bunch of people that will give out some really good information.
Real knowledge, real takeaway. And for a wide range type of people, anyone who's in the world of real estate, this is for them. Just like the key tri-state area event for the real estate market.
And it's also centrally located. We moved it to Staten Island this year, so it's right off the highway, not far from Jersey, close to Brooklyn.
Right, one of the hot markets, as Henry just said.
That's right.
Tonight's show, brought to you in part by the JCon conferences, is all about the upcoming JCon Real Estate Summit, which is going to be taking place on Tuesday, July 11th, just around the block, just around the corner. At the Hilton in Staten Island, centrally located in the tri-state area from Brooklyn, from Long Island, from Muncie, from Lakewood, from Bergenfield, from the whole tri-state area. Now, there's going to be some stars coming in. We're speaking with Henry Stimler. There's going to be stars coming from around the country because the show is all about the real estate outlook in 2023. And that's tonight's show as well, which is a preview of the upcoming JCon conference, the JCon Summit that's around the corner. Now we're going to turn to Joseph Kahn, founder of VisionRE. Joseph, thank you. Thank you for taking out the time and joining us here on Mind Your Business.
Thank you for having me.
Yes, you're welcome. So we turn to you. What are the 3 most important tips to look for when purchasing a property?
I wish it was so simple as only be 3 things, but we'll start out with the easiest one.
Okay.
One is got to know what you're getting yourself into and your market. So if you're, people come to me all the time asking like, how do I get started in real estate? And I always tell them, what do you like? What talks to you? What are the things that, that are going to get you up in the morning and then go there? Is it development? Is it buying a property that's existing? Do you like multifamily? Do you like office? Do you like, there's so many different types of real estate. We have clients, we ask them to manage hotels. Everything has a real estate component to it. What is your interest? Number one thing that's for you. So you got to make sure that something that keep you engaged and keep you interested. It can be something that makes a lot of money, but if you don't focus, the money's gone. So number one thing is what talks to you. After that, the second thing is understanding your market. Henry was talking about the 3 caps, 4 caps, Miami, these deals, the Midwest. We've done work last year, we did work in 36 states. There are so many markets across the country. You got to know your market. And just because the deal is a great deal and the guy bought it around the corner for a 4 cap doesn't mean that the deal 2 blocks over is the same thing. You didn't realize that he owned 36 units next door, but he owns 3,000 units next door. So he's adding another 36 units to him. There's no cost of managing it. He can do a better deal than you can. So you got to understand your markets. Real estate is really a very local business. Real estate literally changes block to block. You have a set of train tracks, it changes the whole area. So you really have to know where you are, know your local area, and know what's important to you and understand that all. That is like one of the most things that's lost the most in real estate is people think, oh, the Midwest, oh, Florida, it's a great market. You got to know your sub-market, you got to know your block, you got to get focused, and you have to understand where you really are. And then the last tip is you got to stay focused. So same way I said in the beginning, it's all about what you know and how you're going to learn it. Start small and grow from there. But if you do the first 2 steps, the third step's the easiest part.
I always say that when you buy a property, the deal isn't done when you buy it. The work starts when you buy it, and you've got to be a good steward of that property. It's not just heads in beds. You've got to look after the property. It's a living, breathing organism, right? And if you don't take care of it, if you don't look after it, if you don't look after your tenants, then ultimately your property's going to fall into disrepair. Your reviews are going to be bad. So just buying the property, that's nothing. It's really maintaining and looking after the
Especially
property.
in the multifamily market, 100%. I came to this realization, last few months we've been involved, let's say the last year, been involved in a lot of these deals that were done in 2020, 2021, and even 2022 that have gone south. One of the things that I've realized is some of the biggest issue is HR. People think I bought a multifamily property, I collect rents. They don't realize that to run a property, you need a staff. You don't have the right staff on a property, you're dead. And HR is so much a part of real estate. Yeah, if you're not good at HR, you can't be buying multifamily properties. Even if you can do third-party management companies, still, it's all about the humans on the ground. If that manager is not collecting the rent or he's not taking care of the tenants and the tenants aren't happy, next year they move out. It's so important. The human part of it is like, people just thought like, yeah, I buy a property, I do some renovations to it, I'm done. It doesn't work that way.
You're providing a service.
You gotta manage it.
You got to fix the toilet. If you wait 3 weeks to fix some tenant's toilet, they're going to write it all over Yelp. That's the first thing you do when you go to a new building is you look at the reviews. If you have a bunch of bad reviews, you're dead in the water.
Yeah, it does. It's unbelievable how much people just forgot that, it's actually a business that you have to operate. People thought they were trading, the old joke about trading sardines back in the Heim, back in Europe, when the can of sardines came along. That's what they thought. They thought, you know what? And the truth is it was like that. I always said that 2 years ago, even if you did a bad deal, you could find the next sucker. That's over with. So if you're not operating properly, you're dead. There's nothing you can do. And we see even good operators, they send themselves a little bit too thin. It's a real problem today.
And by the way, we're also joined by Shimon Eisikowicz from Cross River. If you want to jump in on anything, just jump in, Shimon.
Henry and Joseph are doing a great job. I have nothing to add right this minute, but I'm sure that I'll have more to say shortly. But thank you for the personal invite there.
Amazing. I'm going to turn to my co-host tonight, Shea Rubenstein. But Joseph, just want to share one thing. I love the way you open, say, before anything, you got to know what you're getting into. Isn't that just a great tip on life in general? Before you get involved in anything, just know what you're getting into.
So definitely on that note, so Joseph, since you've been to 36 states and you have been assessing properties for property owners, whether they're on the purchase side or looking to gain value, what do you see as pointers to take existing properties and add that to existing value?
So, it's actually funny. That's how sort of we started out as a development consulting firm back in 2015, early 2016. I came from that background, the not-for-profit side of the world, and I started out as a development consulting firm. We actually got involved with regular value-added multifamily properties. The first time it was a client came to us and said, you're a development consulting firm. I bought a property. I have an extra 30 acres. I want to build more units. I'm in a great market. I want to add more units. And we went there. That was our first time really getting involved in something like that. And we went, it's like 1.5 years into our business. Before that, we were doing more straight up ground up development. We took a property that he already owned, and we went and got approved for 24 additional apartments on the property. And what people don't realize is that even a existing multifamily property, there always are things you can do to increase value and increase returns, whether it's, go putting in self-storage in the property and then charging tenants extra for it, whether it's going around and, starting to charge amenity fees and things like that. They're always, providing better amenities to get the tenants to pay that. There's always things you can do to existing properties to try to increase your returns, make a better tenant experience and things like that. And then people, believe it or not, even in some of the worst markets, if you give the person a better experience, they will pay for it. So you always have to, looking at your operations, figuring out what am I doing today? What do I want to start doing tomorrow? How do I improve my operations? There are a lot of deals that people bought to trade futurely, and you can't do that anymore. So now you got to go back and say, hey, what's going on with my property today? Can I cut expenses, right? We walked the property, let's go back, I think, to November. It's like 600 units. They during COVID, they weren't able to keep their maintenance staff, those clean apartments, and keep the hallways clean. So they brought in a third-party company. They started at $18 an hour. Before anyone turned around, they were at $28. And we were like, 1 second, how are you paying $28? This is crazy. So you really have to be on top of your day-to-day expenses, on top of your day-to-day operations, and figure out, is there an opportunity here? Sometimes, you have units that are down, maybe don't want to invest now back into them instead of giving returns to go put those units back online. You can't, it used to be you just sell to the next person, tell him you go take out a purchase loan to go do that work. You can't do that anymore. So it's really about how do I take what I have and keep it going and do better with it.
And Shea, I always tell my clients, the best way to drive revenue to your property is create a kinship between your current tenants and the property. Because out of New York, nearly every other large multifamily, the turnover is each year 50% will leave. So if 50% of your rent roll is turning, you got to repaint, re-tenant, release. It's a lot of work. How do you keep more people in your buildings? You create a kinship. Kids knowing each other in the building, force their parents to stay in the unit. So make things for kids, make barbecues, get the tenants to know each other, make it a little ecosystem. When they have that, when they have friends living in the building, when the son has a son on the fourth floor and he goes, runs and plays there, they're going to be much more hesitant to leave it, to go across to the next building because they have a kinship to the building. So brand your properties, create things for the tenants.
Yeah, in today's market, that's more important than ever because a year ago you wanted them out so you can raise the rents $300-400. That's over with. You got to be very careful because what happens is when you get all your tenants together, they can also gang up back on you and come back and try to kill you. So it's a careful balance. We've done actually 4 clients pre-purchase. We've actually created events where we brought tenants together. Like we had properties that needed a lot of work and our client was buying it. And we actually sat down and called the community meeting before we actually purchased the property for our client. And we had a meeting with all the residents beforehand. We split them up. We didn't want them all to get them all in the same room. We felt that was too dangerous. So we worked, divided up into four groups, and we called them in for meetings, and we met with them. We've done this more than once with some of our clients, especially on the affordable housing side, and it makes a huge difference. You got to be communicative. You got to discuss things with people. Remember, they live there. This is their life. This is where they're coming home every night, and they're going to be upset at you. They're going to come after you, and they're going to get gang up. So it's very important that if you want to keep people, we told one of our clients recently, they should start adding, Sunday morning playthings for kids, right? And having every Sunday morning, hiring an outside company to do events for kids. They come painting, all those things. And even in their pool right now, they just made a new rule that you can only go to the pool between 9 and 12 on Saturday and Sundays if you're with a child. Why are they doing that? They want the mothers all to get together and meet other mothers and see each other. So it's a huge property. And they made a rule that between the hours, in the afternoon, you get older people there, people are drinking. It's not really appropriate for kids. So from 9 a.m. to 12 a.m., you can only come to the pool if you're accompanied by a child.
And we definitely see this trend around the country. You see amenities being put into all the new properties. And I'm always reminded of, people do business with people, not with products. So it's definitely true that if you make them feel comfortable in the space, it helps whether keeping the commodity or adding, new tenants, less turnover, retention. So that's definitely something, and it's so important. It almost goes to marketing as opposed to real estate, right. But you need to be that full package in order to, like you mentioned, see it as a full package as opposed to you're trading stocks, you purchased it and you're out.
Yeah, it's also a huge mindset change we find for like management companies because the last 6 years, the goal was actually to get them out, and now that's over with. So it's been a very, very hard reset for the companies. But, we do asset manage our properties. We're constantly talking to management companies. And this is really something that we're pushing on our third-party management companies. You got to go back to that way of doing business back in 2012, 2013. We're trying to keep the tenants there. We're in a new market, as Henry said.
So that makes sense. So the question now is, we discussed about, what to look in a property and how to add value. But now on the flip side, because it's not the way it used to be, how do you come in and do cleanup? So they bought the property, they ran into trouble. How do you navigate their exposure?
So it's been very interesting times in our office here. We've worked actually very interestingly. Sometimes we're working for the GP, which is general partner, the person who put together the deal. They've been hiring us. And there have been times we've been hired by what we call the LPs, limited partners, the investors in the deal. And we've been doing this, across the country. I think our staff has walked just in properties that people already own. We've walked in the last 12 months over 10,000 apartments trying to help them figure out what they need to do and what's going on there. And we're, every day of the week, we have someone out at a different property trying to help clients with this. It's a real problem. Every one of them has a different story. It's much more nuanced, much more complicated. I think the one overarching thing is that a lot of these guys took bridge debt, didn't have, floaters, and there's no exit. There's no exit here, which is a problem. Some of them are, there's no such thing of a guy not doing a bad deal. Some of them are bad deals, and a lot of them also just need focus, right? It's when you were planning on selling it in 2 years and getting out your money, and it's not happening now. It's natural to get depressed and try to to fight on is very hard.
Also, they can't pay any returns to their investors because they're just paying all the money to keep current because the cap rates weren't tight enough, or they need to buy a new cap, which costs a fortune today. So your investors aren't getting money. You're not making any money, but you still have to operate the property. You're basically, all you're doing is working for the lender.
Yeah, and it's even worse than that. It's not only working for the lender, is that a lot of these guys have never been through a down cycle, and they just can't see the light at the end of the tunnel. So sometimes we go in there and we're like, there is no light at the end of the tunnel. There's a deal that has to go back, unfortunately. And that's part of the businesses that, when banks underwrite loans, they understand that, 3, 4, 5% they are going to come back and go into receivership. It's just the way, of normal underwriting and risk reward.
Do you ever get involved on the financial side to try to help bail them out if it's a financial consideration?
We've successfully just recently, for the first time, we're not in business long enough to have done workouts back in 2008. We actually just did our first workout with the bank, with a private lender recently. Sometimes yes, sometimes no. I think banks are starting to wake up and realize more today than they were even 3 months ago how big of an issue they have, and are becoming a little bit more willing to work with you. It's a big process. It's sort of like those 7 stages of denial, or maybe up to stage 3 or 4 with the lenders. They're starting to realize they have a problem, how they want to deal with it.
Shimon, do you want to chime in? Shimon, would you like to chime in on this issue since you are the bank?
I would absolutely love to chime in, and I appreciate that. Yeah, to your point, Joseph and Henry earlier, but without a doubt, certainly banks are recognizing the challenges that some borrowers are facing. And what I think is crucial, similar to the comment you made earlier about tenants and landlords having communication, it's the banks and the borrowers having that open dialogue. It's crucial to saving, even if it's not the best deal today, or it's not the deal that whether the lender envisioned it that way, or whether it's the deal that the borrower envisioned, it's the communication that is crucial to salvaging a deal. And we've seen deals, in the 27 years that I'm doing this now, I've seen good deals go bad simply because the communication gap exists. And even if it's not the best deal, communicating that will generally encourage both the borrower and the lender to come back to the table and restructure it where it's amicable for everybody. Nobody wants to win here, right? This is not the bank saying, okay, we're in a better position, we're going to leverage that. It's all about communication. And at the end of the day, if you communicate properly, everybody wins. Otherwise, everybody loses. There is no middle ground for the most part there.
And there's a new paradigm as well, which we haven't seen before, Shimon. I'm sure you've seen it, of these big, huge institutions just handing back keys, right? It's now cool. It's in vogue. Blackstone have given back keys. Huge companies, Starwood, they're just saying, you know what? I'm washing my hands with this. Yesterday in San Francisco, the Tyson family, which is one of the largest families in New York, handed back the keys to 2 hotels of over 1,000 keys a hotel. This is a brand new paradigm. So I couldn't agree with you more. If you have a problem with your loan, don't bury your head in the sand. Tell your lender, because communication is so important. And most 9 times out of 10, they're going to work with you. They don't want to own the property. That's not what they're in for. They just want to be a good lender.
Well, it depends on which lender we're talking about. There are some that are predatory lenders, but I always tell my clients who come to us on the GP side and are having issues, if you're honest with your bank, your investors, everyone will be happy to work with you, not only now, but next time around as well. So, there's a story, we're not going to go into names here now, but, in New York, someone who ran into issues around 3-4 years ago in New York, and they worked with the lenders, they worked with everybody. They personally were wiped out as a GP, but they're doing deals again. Why? Because the banks appreciated that they were honest. They understood they made some mistakes and some issues, but they never tried to hide the problems and if you want to survive, it's very similar to 08, where a lot of the big families were able to survive, and a lot of the big lenders, Star Wars of the world, was able to survive 08 because they worked with the lenders. I think on the office side now, they realize there's just nothing they can do. That's why they think it's in vogue to hand back the keys and not to sit there and fight. But yeah, if you're honest with your investors and you're honest with your lenders, everyone understands that, it's normal. Not every deal it has to work out.
And Joseph, that's to Shimon's point before about communication, just straight up.
And Americans love a comeback story. You guys love a comeback story. You love the underdog story. So comebacks are very cool in the US. So it's okay if you are down at the bottom, you can always come back.
But as long as you don't do anything stupid along the way, like I always tell my clients, read your docs. There are so many things that you could do that would create either mortgage fraud or create other issues or create you with defaults. just be honest. I know it's very hard for people to stand up and admit their problems, especially go back to lender with their head, behind the thing. And it's hard. It's not easy.
Not always an easy conversation, but it's the right thing to do. Again, going back, using your example, Henry, 2008, the first thing, we did as a bank and every other bank out there, you look back, you look at the relationships you have and how they dealt with the problems during the crisis. Everything, things will pass. This environment will pass the same way. We will look back and learn from it. Certainly some mistakes were made and some mistakes will still be made, but you can learn who you want to do business with as this passes. And those are the relationships, certainly as a bank, we're going to look to keep. And I'm sure other banks are going to do the same, because there are going to be borrowers. They're going to hand back the keys. Sometimes that's the only answer, but it's all about how you go about that default or that unfortunate situation.
And Joseph, as you mentioned, you've got some lenders that are very aggressive, that want to take the properties. Those guys, people will never go back to them. If they have a name now in 2023 that are aggressively going to take properties back from people, in the long run, they're not going to get business, because people will stay away from those lenders that are too aggressive and won't work with you. They'll know for going in the future, this is a lender I don't want to work with. And me, myself, I won't bring business to them, because I want my lenders to understand and be in the foxhole with my clients.
And this is a great conversation. I'm happy that it went on for this long, because it's such an important topic. And of course, to just give a little promo to the upcoming JCon Real Estate, this is some of what will be discussed. You have people that are coming from industrial, multifamily, construction, development, finance, and all these people want to know what the state of real estate and what that forecast is that's going to take place over the next 6, 12, and 24 months. So once again, for more information, to register and see who will be headlining this event, visit attendjcon.com. That's ATTEND. JCon.com. Once again, the event will be held on Tuesday, July 11 at the Hilton in Staten Island. Back to you.
I think we got to give Shimon, a word to. Shimon joined, but he has a lot. Perhaps we could jump in with some questions. Cross River Bank.
Sure. And Shimon, thank you for joining us. And I think we can get more of a unique perspective. We've heard from, the leasing side, the purchasing, or maybe even how to value property. But my question to you from the lending side is, I guess you're on the other side of the table. So how do you assess how the state of real estate is slowly changing, or how do you forecast it changing over the next 12 months?
So first of all, thank you so much, Shea and Yitzchok, for inviting me here this evening. Henry and Joseph, great meeting you and spending some time with you here. So thank you for the opportunity. Loaded question there, Josh. Obviously, we're in a very volatile environment. It goes without saying, many challenges exist today that many people were not expecting or certainly not prepared for. So it's certainly a challenging environment, but along with challenges, I find that this is where the best opportunities present themselves. Certainly easier said than done, and I'm certainly not minimizing, some of the, challenges that certainly exist. But I could speak for myself, speak for the organization, for Cross River. We've been through some ups and downs. We were born in the height of a crisis in 2008, so we understand, some of those dynamics. I'm doing this, 12 years prior to that, so I've seen some ups and downs, and certainly some challenging environments through the 27 years or so that I'm doing this. And it's really about sticking to some of the fundamentals that may have gone to the wayside over the last few years, when it was more like shooting fish in a barrel, and you found the deal, it made sense, there was upside. All you had to do is, as Joseph and Henry both said earlier, a little bit of CapEx, a little bit of a turnaround, and your building's worth more. You can refi, pay back maybe some of your investors if it was a syndicated deal, or just put money back into your pocket and do it again. Some of those fundamentals or some of those opportunities rather are probably not as prevalent in the current environment, but along with it, others will present themselves. We may not see them as opportunities, as I said. You may have to peel back some layers there in order to identify them. But rolling up your sleeves in this environment is probably the best thing to do right now, where we will all look back and recognized that this was probably a better opportunity to develop some real wealth in some real tangible assets, as opposed to some of the other kind of buying and dealings that occurred during the last cycle, or the last few years, certainly, of the cycle. So certainly a market of opportunity, but maybe not the same or the way people expected it to present themselves. So a little bit of hard work, a little bit of creativity. I think this is probably the best market for that.
As they say, when there's blood on the streets, buy land. And there is definitely blood in the streets. So, Joe, I think would you say this is probably one of the greatest opportunities to buy and establish wealth in our lifetime? I'd say yeah, right?
I don't know if we're there just yet. I 1,000% think in the next 6 to 12 months, especially if you can pick up a building, an office building, and figure out a way to repurpose it, and you're paying 25 cents on the dollar what the last person paid for it. I was in Knoxville, Tennessee this week, and we saw a building. I'm going down the street, and the guy goes to me, that looks weird. It's a hotel. It was once an office building, right? If you can take that opportunity of buying something at 25 cents a dollar, and you can figure out how to repossess it, either put apartments or something in student housing or something like that, you'll create real generational wealth because your entry point is so low. That's, it's not about just making that little gap from the 4 to the 5 cap and selling it at a 5 cap or refining at a 5 cap. Yes, you made money, but that's not generational wealth. People who got into this business in 2009, 2010, 2011, a lot of those people created generational wealth by doing that. And it's every cycle we've been through in real estate for the last 100 years, and there's been plenty of cycles. That is what is. The people survived the 1992 cycle and started that. As long as we can get the lending side, which is where we need Shimon and we need Henry to actually give loans on those deals and figure out a way how to make those lending work, there's real opportunities going forward for everybody.
Yeah, on the office conversion side, it's very interesting you mentioned that, because NEWMARK just did a very, very large deal. 115 Water Street was the former JP Morgan bank building. The principals of NEWMARK bought the loan, foreclosed on the deal, took the deal for pennies on the dollar, got themselves a construction loan, and got the mayor and Hochul to change the designation of downtown from office to apartment. And now we're going to do the largest conversion in history, over 1,500 new units coming into New York. And for them, it's a basis play. They bought the bankrupt building. They bought it for pennies on the dollar. It lends itself to a conversion. So that's going to create a tremendous amount of wealth and a tremendous amount of needed housing. So if you can find a way to understand how to do that within the office market, then you're going to crush it. Right. Or to buy properties that somebody else hasn't been able to look after. He bought it too expensive. He took out too much of a high octane bridge loan. He's screwed. You come in, you pick up the pieces. That's where the opportunities are going to be.
It's definitely about the angle. So I guess my next question to you, Shimon, is an interesting one, because it plays more into the secret sauce of lending. So you're on the bank side. We come to a bank, ask for a loan. We either get it, we get spinned, or we get turned down. So what are some of the ways to establish a competitive advantage in the lending space?
I think, competitive advantage in the lending space, competitive advantage in the borrowing space. So I guess we'll focus on the borrowing space, but which, again, goes back to some of the fundamentals that a lot of people really got away from or lost sight of, especially in the last boom market, if you would. And people didn't focus on some of the basics. And some of these things are really so fundamental. It's really relationship. And I know it sounds so fundamental, and it almost sounds like, not even worth saying, but I wrapped the meeting literally back to back to this, to us sitting down here tonight. And I was, I had a client come in here that for years I would see, and certainly a very active local client here. And, we never got anything done. He has, brokers that broker his deals for him at different banks. And, we just never developed a relationship. He reached out to me last week and said, we spent some time. I'd like to come into your office. I'd like to go back to the basics. I know you're active. I know you've been active. You've stuck to your fundamentals through all the years, even though other banks were, maybe a little more aggressive than you were, maybe offering a little more dollars. I'd like to start the relationship. I'd like to come into your office, meet your team. Let's build the relationship, because I know that's what I need to do for me to survive this cycle. And of course, I welcome the opportunity. And I'm finding more and more clients like that are going back to the basics. Sure, there are other banks out there. There are other lenders. We're not the only game in town. I recognize that. But the reality is there are fewer and fewer banks that are active in this space, especially in this environment now. And, I'm not too proud to go back to those basics. The fundamentals are crucial. And I'm happy to build my network and build on the relationships. And I'd love to be the bank for those borrowers and many others. I know I won't be the bank for every borrower. I can't be. But I'd love to have the opportunity to build those good old-fashioned relationships, shake hands, meet people face to face, and be able to do things for them that I wouldn't ordinarily do if I didn't have that kind of intimate relationship with them that is only going to get developed more and more in this environment.
That definitely makes sense.
You have the time now because transactions are down by 75%. That's a huge drop of transactional size. I don't know if you saw the numbers last year on the multifamily sales side, how low it is for the first 2 quarters. So now you have the time. You have the time to build those relationships. You have the time to be there as a sounding board to your existing clients. You can help people that are in a little bit of trouble, be a voice of reason, try and help them, find them rescue capital, find them alternative lenders that can help them. So this is the time now that you can endear yourself to a lot of people that have never really given you the opportunity. All those who are your clients, you can help them out because we're not so busy doing hundreds and hundreds of transactions like we were a year ago.
More importantly, I think that, when you have a relationship with a lender and he trusts you, so if you come there with something that's unconventional, but he knows who you are and he's seen you before, he'll be like, okay, I know you are, I know you can execute and get this done. We have a deal that we worked with a client. It was a very unconventional deal. A local bank that had a relationship with him, knew him, was willing to do it. That's why relationships right now, especially where the money is to be created, you need to have those relationships. It's not just about numbers. It's about trust in the person of execution.
That's definitely true. And then, Shimon, going back to lending, so from your bank perspective, or maybe even the broader view, are you doing construction? Are you cutting back on construction, multifamily, single family? Where do you see, because of today's market, that you're pulling back, or just the opposite? You're just leveraging less, but you're willing to keep it in that category?
It's a great question. So actually, and please, thankfully, you're asking some great questions. The answer is we're not pulling back. We're being careful, but we've always been careful. So I don't think much has changed for us the way it may have changed for some other banks that may have been a little more aggressive, in order to stay competitive. We've always taken the approach of rate is not going to be the driver necessarily of a good deal. It's going to be more about the good old-fashioned relationship and sometimes a little hand-holding to make a deal work, a little more creativity. And that's something that has always been, it's part of our DNA. It's the way we built this business. We're in a very, as you know, this is, the New York tri-state is the most competitive real estate market in the country, in spite of everything that's going on. Sure, there are very hot markets and pockets in other states, as we've discussed. But at the end of the day, that the only way to stay somewhat competitive or even relevant in the most competitive market is to go back to the fundamentals. Tap into that creativity, sharpen your pencils, roll up your sleeves. It's not only about rate. It's not always about dollars. Sometimes it's about how creative you can be to get your hands around the deal. This environment is no different. If anything, it's much more of that. And we're seeing, Henry, to your point, yes, volume might be down in terms of transactional volume, in terms of sales. Absolutely. We are just as busy as we were a year ago today. Not so much because more sales or less sales. There are always opportunities within the market, whether it's somebody who's having trouble someplace else, and if the bank is willing to structure or customize or tailor a deal today, there are very few banks that have the ability or the wherewithal to do it. And many of them are dealing with the problems that they have from deals that they made a year, 2, 3. They don't have the time or capacity to try to structure a deal today. So we're actually seeing a tremendous amount of deal flow. We're not doing most of them because they just don't make sense, but where it could make sense or where we could be competitive, we're happy to roll up our sleeves and structure a deal and tailor a deal that works. But of course, it has to work for everybody. And believe it or not, it has to work for the bank as well.
And we have a little bit of an unfair advantage because especially in the multifamily space, we're a Freddie Fannie lender. So the agencies, $160 billion to put out, right? So they're very competitive. They're very aggressive, especially with mission affordable deals, very skinny rates. And you can be somewhat creative when it comes to the agencies as well. The banks, to me, as well, you can pick your spots. Certain banks will be more aggressive on certain deals, but there is still liquidity out there. It's a misnomer to say there's no money out there. That is totally not true. It's not reminiscent of 2008. That is not the issue. The issue here is interest rates and cap rates. That's the issue this time, not liquidity.
And just to add to that, Henry, great point, Henry. I just want to add to that. I think one of the biggest mistakes banks made in '08 was slamming the brakes, shutting their doors, outside of not having liquidity, which they can't control if that happened. Otherwise, this is the time to write those loans that are at significant premiums and much more secure than some of the loans that banks wrote in the last 5 years. This is the opportunity to diversify and write even better paper instead of just shutting your doors on the borrowers that need you most.
Very well said. And I think this is a great sample of what you'll see when you come to the JCon Real Estate Summit on Tuesday, July 11 at the Hilton in Staten Island. And once again, I am Shea Rubenstein from the JCon, inviting you to attend Tuesday, July 11 at the Hilton in Staten Island. For more information and to register, please visit attendjcon.com, where you'll see the full lineup of all our speakers, panelists, mentors, and as Yitzchok mentioned before, great food, and even a mixologist for the wine bar.
What a great show. Tonight's show, the real estate outlook in 2023. And again, it's just a sampling, a teaser of what people can expect at the upcoming JCon Real Estate Summit, Tuesday, July 11th in the Hilton in Staten Island, 4:30 p.m. and on. It's a solid 5-6 hours of information, anything about the status of the real estate industry in 2023. Tonight's specials, thank you to tonight's incredible lineup. My co-host, Shea Rubenstein, the brainchild of the JCon Business Conferences. Henry Stimler, Executive Managing Director at NEWMARK. Joseph Kahn, founder of VisionRE, and Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank. This wraps up an incredible edition of Mind Your Business. Tune in again next Sunday night for another great edition of Mind Your Business right here on the Voice of New York, 710 WOR. Have a successful week. Thank you for watching, and make sure to subscribe to this channel and be notified every single time a new video goes live. Don't miss out on any of the weekly interviews that I have with top business leaders, sometimes Fortune 500 executives. Hit subscribe and turn on notifications.